Imagine a market where assets routinely swing 20 to 50% in a single day. For the uninitiated, these massive moves lead to rapid losses. But if for a strategic trader, that level of daily volatility provides a consistent baseline for profit. This chart shows the concept of a high beta altcoin. Beta measures an asset's volatility relative to a benchmark, in this case Bitcoin. If Bitcoin trends up by a modest 5%, a high beta altcoin amplifies that movement, surging 15% or more. Solana is a prime example of this environment. Backed by a massive ecosystem of decentralized apps and network upgrades, its price swings aggressively on both technological developments and market sentiment. Navigating these swings with traditional spot trading is rigid. You buy the actual tokens, and if the market suddenly reverses during a volatile session, you are forced to simply hold the asset and hope the price eventually recovers. Contracts for difference, or CFDs, offer an alternative. Instead of owning the underlying token, you enter a contract with a broker to exchange the difference in the asset's price from when you open the position to when you close it. This allows you to speculate on price direction, meaning you can easily open a short position to profit from a decline. CFDs grant you short-selling flexibility and leverage, but they operate on mechanical rules that spot trading doesn't have. If you enter this market without understanding those mechanics, an unexpected 20% swing can liquidate your account in minutes. The core engine of a CFD is leverage. Leverage allows you to borrow capital from your broker, giving you the ability to control a position that is significantly larger than the actual cash you have on hand. To open that position, you put down a deposit called initial margin. With 10x leverage, a $1,000 initial margin deposit unlocks a $10,000 Solana position block. Once the trade is live, you have to monitor your maintenance margin. This is the absolute minimum amount of equity you must maintain in your account to keep the broker from closing your position. If a sudden high beta price drop pushes your total account equity below that maintenance threshold, you receive a margin call. If you don't immediately deposit more funds, the broker steps in and automatically forces a liquidation, locking in your loss permanently. Leverage accelerates your buying power, but the exact same mathematical multiplier will trigger a forced liquidation if you fail to manage your downside risk. If you trade perpetual CFDs, contracts with no expiry date, you also have to account for funding rates. These are hidden, periodic costs required to hold your contract open. Funding rates keep the CFD price tethered to the actual spot price of the token. If market sentiment is highly bullish and most traders are buying, the traders holding long positions must pay the traders holding short positions. This exchange typically happens every 8 hours.
Let's say you hold a $20,000 leveraged long position on Solana during a hot bull run. A positive funding rate of 0.05% paid every 8 hours means you are spending $30 a day just to keep your trade alive. Over a week, that drains $210 directly from your account. Holding a position too long without accounting for these recurring fees will easily consume the profit of an otherwise correct directional trade. Because of these amplified costs and extreme daily swings, the tight stop losses used in standard Forex markets will guarantee failure here. A normal 5% dip will knock you out of a Solana trade instantly. This chart shows the vulnerability of static boundaries. Instead of placing a stop loss just below a recent low, calculate it using the average true range, or ATR. ATR is a metric that measures the actual current volatility of the asset, giving you a dynamic, wider boundary that survives normal price wicks. You also need flexibility in your entry point. Rather than deploying all your capital at a single price, you scale into the position over time. A 3-tier approach works well here. You buy a small portion on the initial dip, accumulate a second tier when the price hits a known structural support level, and add your final tier only when a breakout is actually confirmed. When that breakout hits and the token pumps 20%, you scale out. Taking partial profits immediately secures your capital against sudden reversals. Waiting for a massive maximum return often means watching your gains vanish, but you have to verify the breakout first. Looking at these two price spikes, one is a trap manipulated by large holders on low liquidity. The other is supported by a massive spike in trading volume and fundamental catalysts like a network upgrade. Always confirm your price action with volume data. Static rules break in high beta environments.
Surviving these markets requires dynamic entries, wider stops, and execution tactics dictated purely by current volume and volatility. Every strategy we've covered relies entirely on one overriding mathematical rule for capital preservation. You must never risk more than 1 to 2% of your total trading capital on any single CFD trade. When Solana drops 25% in an afternoon, fear tells you to panic sell at the absolute bottom. When it rallies 40% the next morning, the fear of missing out screams at you to buy the top. A strict predefined risk limit established before you ever open a position is your only mathematical defense against those emotional urges and the inevitable chop of the market. By calculating the true cost of funding rates, respecting the absolute limits of margin, and scaling your entries based on volume, extreme volatility stops being a threat. It becomes a calculated strategic advantage. You can put these dynamic strategies into practice and test your risk management systems in a live market environment risk-free by using a demo account on FXNX.